Thank you, Rob, and thank you, Wendy. So yes, as Wendy said before, we are going to trial a little bit of technology as we go and have some interactive polling through this, so fingers crossed it all works well. Firstly, when Rob asked me to come and think about presenting an insurance topic, you know, it's usually when the topic of insurance comes up, it's one of the most deflating words you could ever possibly share with someone. So it's always a tough ask. So we've got to just plough on and keep going on with it. But thankfully, I brought my colleague Daniel with me today, widely regarded as an industry entertainer. So if it all goes pear-shaped, we've got a stand-up comedian on standby, which is fantastic. So thank you, Daniel. Also, I will say from the outset, thank you, Jeff. Incredibly informative session just prior to this. And I will thank you yet again for the segue into the topic of insurance. Before we kick off into this, just a little bit to follow on from what Jeff said before. Usually in times of economic prosperity, a lot of people are actually prepared and they're happy to take on risk. And confidence actually breeds a little bit of that confidence, because as a business owner, you might be prepared to carry more risk on your balance sheet. You might be prepared to not insure something. You might be prepared to take on that responsibility yourself because you think, you know what, everything's going great, it's all fine. As we move into periods of economic uncertainty, what we find is risk then becomes front of mind for everybody. People start to get a little bit nervous around protecting their balance sheet. They want to protect their assets, they want to protect their investments, they want to protect their people, and they want to do it in a way where they start to lean on the insurance sector for that guidance and support. So we're at a period of time at the moment where we as insurance professionals tend to be in more demand than we ever are before, purely for that very reason, that people are trying to de-risk either themselves, their personal assets or their business assets. So we want to talk a little bit about that today, some of the challenges that Jeff raised in terms of the economic environment that surrounds us, the geopolitical environment and the impact that that's having on the world around us. But more importantly, when I hand over to Daniel a little bit later, we'll talk about what does that actually mean? What does it mean for me? What does it mean for my business? And what are the actions that you can possibly take to make sure that you're taking control of what's going on to rebuild that confidence? So, we did have another colleague, Chris, who was going to join us as well, but he fell ill this morning, so we told him just to not come and be part of this group. So it'll be myself and Daniel running this session. So firstly, and this is a lot of insurance professionals, we get proud of our occupation and proud of our industry, despite what others might say. But a common statement that gets made in the insurance industry is that every business in the world, regardless of size, simply cannot move without access to the founding stone of capitalism, which is actually insurance. So you have a think about everything that you do with your business. You can't sign a contract, you can't take on a new contract without providing evidence of insurance. You can't get funding for your business without evidence of insurance. You can't employ your people without insuring your people. Everything that goes on, you can't transport goods without those goods being insured. Everything that moves in a business environment is ultimately underpinned by some form of insurance in some way, shape or form. So whether we like it or not, it's a very, very important part of how we do business. And we're trying to change the terminology and the thinking of it being a negative topic into something that's very valuable. And we'll go through a little bit of history. So what we're going to talk about today is we're going to talk about the origin of the insurance industry and actually how it shaped the modern economy. We're going to talk about Lloyd's of London. Those who are unfamiliar with it, everybody knows the terminology, but not many people actually understand what it is, how it works, how you access it, and what services it provides. We're going to talk about significant insurable events in recent years and what the trends are looking forward. We're going to talk about what those events actually mean to you, either from a personal perspective or through your business. And we're going to talk about how you can navigate your way through these times to make sure you don't become a victim of the circumstances that surround us, but you can actually exercise and regain control. So, as insurance professionals, we hear lots of terminology targeted towards us, but we want everyone to be fully frank here. and be as open and honest as you possibly want to be. So we want to know, what are the first words that come to your mind when you're asked to describe insurance? And don't be nice to Daniel or I, be open. Sorry? Well, you got to use your app.
Sorry.
Yeah, sorry, I should have said that. Yeah. Yeah.
There's some good ones, but they're fairly polite so far.
Yeah, crooks is a good one though. Yeah. So there's a couple of words that are starting to stand out here for us. They might be security, safety net, risk mitigation. That's about as many as I can see that are positive.
What does FFS stand for? I can see that.
Yes. Yeah. Thieves, that's a good one. So we all done? So it is. But it's a typical reflection of the word insurance and how people naturally respond. It's there to protect in the event that something goes wrong. So anytime someone needs to use or access insurance, it's typically through a bad experience. Something bad has happened and it's up to somebody else to try and step in and actually fix that problem for you. So there's an element of negativity even when you enter the industry for the first time trying to get something resolved. So a lot of this doesn't surprise us. And I'm actually going to share with you, if we're done, I'm going to move to the next slide. Here's what we hear. This is pretty consistent. Again, necessary evil, it was the first one that came up. Very, very common. Waste of money. Legalised extortion, that's a good one because we actually, Daniel and I picked that up at a Vic Leaders meeting in this very room about 3 sessions ago, so we couldn't not put that one in there. A grudge purchase, a lottery purchase, you just don't know what's going to happen. I don't believe in insurance, they just never pay, and I'm only paying for the losses of others, which is why my premiums are going up. So we start from a position of negativity in this industry. What we want to do is we want to get people to start to realise, are they about a lack of understanding about insurance and the role that it performs? Because as I said before, in reality, nothing moves without insurance. And what we want to use today's session about is we want to change the conversation and change the narrative to make sure that insurance can actually become a topic of one that's where we refer to the industry and its products as an asset. And that's really, really an important difference to some of the terminology that we've seen before. What I want to do, I actually want to use history to explain this. And I want to go through the origins of the insurance industry to give you some samples and understanding around how it's become an asset and how it's shaped the modern economy before we start to look at what it means today. So we're going way, way back now into the Babylonian times, because this is actually when the first recorded insurance policy has been found in any level of history. What we found, and I don't speak fluent Babylonian, but I'll refer to him as King Hammurabi, had an example, fearless guy, as most fearless leaders were at the time, actually had written into his code of law that a debtor did not have to pay back their loans if a personal catastrophe made it impossible to do so. That could be his wooden factory or his wooden shop burnt down, could be he became disabled in a fighting incident, could have died early. That's the first known recording of insurance ever in our times. So it dates back a long, long way. Babylonian times, way BC, 1700 I think. Then we move forward to the Middle Ages. And this one I actually find genuinely fascinating. Because back then, craftsmen operated under the guild system. And the guild system is essentially like-minded craftsmen, tradesmen, however you want to define them, who came together to form an association of like-minded experts who could provide services. So really you think Nika, Pavel, master builders, Plumbers Institute, Association, etc., that all steeped in the roots of the guild system by bringing commonality of trades together. What happened back then is a great program. Masters would train apprentices and try and get the cycle continuing to move. But what happened is back then, they introduced a program where those masters had to pay dues. And those dues were actually set up as a quasi-insurance fund. So if anything actually happened to the master, where he couldn't continue that process of training any of those apprentices under his wing, then what would happen is that those dues would step up, make sure that the master's family were being provided for, but also provide continuity of training for the apprentice. Now, what that ultimately led to, when we're trying to develop industrial economies as far back as the Middle Ages, is that safety net alone encouraged more people to leave farming to take up trades. So we would ask the question, did insurance actually create the framework for what would ultimately become the first industrial revolution by underpinning the creation and the development of skilled labour? Would we be in the same model that we're in today without the fundamental principles of insurance? Then the world began to trade, and in the 1600s shipping began to connect the old world with the new. What would happen is that these voyages had to be funded, and venture capitalism really started to come to the fore, because someone would invest into that voyage, but their return was what was actually obtained in that land that they arrived at, and the venture capitalist would get a percentage of what was discovered in that new land. But what happened is these venture capitalists thought about it and they said, I wouldn't mind de-risking this opportunity. What I might do is I might try and sit down and meet some people to find out, can I spread that risk, or can I transfer or pass that risk into another environment? So what happened is these venture capitalists would then head off and they'd meet at a coffee house known by a gentleman called Edward Lloyd. And the ship's cargo manifest would get shared with all these investors who might want to take a piece of that risk. And they wouldn't insure one vessel or one cargo or one voyage in its own right. They wanted to spread it. Let me take a piece of that one and a piece of that one. Maybe I can take a piece of all these different new worlds and have it underwritten so my venture capitalist venture is actually protected. Interestingly today, 500 years later, insurance transactions still get done in coffee houses, don't they? And pubs, yes, yeah. This is where Lloyd's of London was born, ensuring these voyages where we're connecting the old world to the new. And Lloyd's of London, a very, very famous institution that everybody, I'm sure in this room, has heard of before. I do love this statement, that not a breeze can blow in any latitude, not a storm can burst, not a fog can rise in any part of the world without recording its history here. That image there is actually at the Lloyd's of London headquarters. And they have shipping manifests dating back to 1775 on display. So if you want to embrace history and understand a bit about the origin of an industry, not just insurance, but voyages and what was discovered and connecting old worlds to new, you can actually read through those cargo manifests dating back to 1775, and they're still on display to this day, which I think is wonderful. Then the next event that we had was the Great Fire of London. And those probably aware, this famously started in a small bakery and then took off and destroyed an entire city. Took out 13,000 buildings. The vast majority of those in the day were wooden, didn't last very long. And this was at a time when the great city of London was still recovering from the events of the plague the year before. So what happened after that is a lot of these, whether they be the venture capitalists, the underwriters who were supporting all these voyages, were absolutely destroyed about what had happened to their great city. And they wanted to try and do something about it to prevent that from ever happening again. So they all got together, same coffee house again, and they came up with a way to create fire insurance and offer that to businesses that had just rebuilt themselves. Then that was made available to all of those businesses who had rebuilt in that great city of London. And that moment alone in 1666, when those guys came together, is when the modern insurance industry was born. Now we say that because those businesses would never have been able to continue once they were rebuilt without the development of insurance to protect them moving forward. Because they needed the safety net, they needed the security to make sure that if something like that ever happened again, they wouldn't be destroyed. And that fire insurance team of underwriters at that coffee house in Lloyd's provided that certainty. So we as insurance professionals, we really get excited about some of that history that our whole industry is attached to, because it goes back a long, long way. Right, next question. So, everyone's heard of Lloyd's of London. What is it? You've got 4 answers down there. Is it an insurance company? Is it an insurance broker? An insurance marketplace? Or a tourist attraction? Everyone done? Whoever said a tourist attraction, it's actually technically correct. You can do tours of Lloyd's of London, and if you ever get the chance and you're in London, I would strongly encourage you to do it. It is one of the iconic buildings of London, and the history that is contained inside that building and how you understand how the City of London came together, it's really fascinating stuff. It's really renowned. There's 1 square mile of London that surrounds the Lloyd's building, and the GDP that is created through that 1 square mile alone outweighs the rest of the GDP that the rest of Great Britain generates. So it's very famous, that square mile. To answer the question, very well done, because the correct answer was C. It is an insurance marketplace. This image here is actually Lloyd's inside. And a lot of people who've seen this photo go, geez, it just looks like a shopping centre. And the reality is that's what it is. It's an insurance shopping centre. Because it's where buyers, who are clients and insurance brokers like Daniel and I, and sellers, the underwriters and the managing agents, come together to buy and sell insurance products. And typically the way that it works is, as an insurance broker, you will either do it on your own on behalf of your client, or in a lot of cases you will have your client with you in attendance. And you will attend one of these desks here, which are called underwriting booths. And you're not allowed to make appointments, it's very steeped in tradition. You just have to go there, and you hope that the underwriter is there on duty that day. Then what you do is, if he or she is prepared to see you, you get to pitch your case as to why they should deploy their capacity and participate on the insurance program that you want them to participate on. It's a fantastic experience. I've done it a number of times over the years. It's something that is incredibly unique and something that you never forget as well. But if you are working with an insurance broker in your business at this stage and you have very, very hard to place risk, as Jeff said before, insurance capacity can be tough to get sometimes, and your insurance broker says we might need to go to Lloyd's to get capacity, if the opportunity is ever there for you to align yourself and join that insurance broker to go to Lloyd's and pitch that case to get some insurance capacity, always say yes. It's an outstanding experience. But how does Lloyd's work? Now, there's a lot of detail in this slide, and I won't go through it in huge amounts of detail. But I know the one that fascinates Rob all the time is syndicates are one of the key parties that participate in Lloyd's. So syndicates are really essentially investors. They can be individuals or corporations who are prepared to put their capital down to be used in an insurance capacity to provide or support risk on behalf of an individual or a portfolio or a pool of clients. So anyone in this room, if you want to become an investor or an underwriter at Lloyd's, you just contact someone that you want. If there's a particular area of risk that you're interested in, you can actually put your capacity and your capital down and you can become a Lloyd's underwriter or a syndicate provider.
What's the minimum? What's the minimum?
It depends on the syndicate and the area of specialism, Jeff. You'd probably be talking £1 million would be your entry ticket if you wanted to. But you can group with people if you want.
Sure.
And group with people, and you might, with a group, put £1 million together and say, what I prefer is risk with a short tail. So I know I'm going to understand that return sooner rather than later, because you might want to avoid long tail liability type exposures that can go out for years, if not decades. So it depends on what you want.
So, Brett, put simply, if there's a fire insurance syndicate
Yep.
and we all decide we're going to put together and we go into that, we are guaranteed a certain, well, so not guaranteed, there is a certain level of return we can earn depending on how that fund performs, which is dependent on how many fires there are globally. Is that a simple?
Yeah, I'll go back one step. So once the syndicate decides how much capital it's got, it then shares what that capital is with Lloyd's of London as the owner of the marketplace. Lloyd's will then sign off and say you are allowed to deploy this much capacity or capital over the course of a 12-month period, but you cannot go over that amount. And then they'll measure your performance results based on the capacity that was laid out through that limit that they gave you versus the claims that came in and the losses that were paid out, as well as including what we call IBNR, or incurred but not reported claims that might come in at a future point post-renewal. So it's heavily regulated. Lloyd's themselves, like, it doesn't guarantee success. There's been a number of syndicates that have gone belly up because they've made the wrong call on the wrong asset classes or the wrong risk classes. And Lloyd's do a review every year. And sometimes they say, you don't meet the minimum expectations, your profitability doesn't meet our minimum expectations, we don't see that turning around in the next 2, 3 or 5 years, they'll remove your licence. So your capacity gets pulled from the market.
That actually happened not too long ago, where Lloyd's did a sweeping review of a lot of syndicates and their criteria for eligible syndicates tightened up. So the lack of what that led to was a reduction in capacity, which is one of the ingredients to a tougher market. So that's one of the ingredients to the insurance market, which we'll talk about in a bit more.
And then you've got managing agents. So once the syndicate's got its capital, it needs the expertise of the managing agent to control that. And the managing agent will typically employ the underwriters with the expertise to underwrite risk and determine whether they're going to deploy your capacity or capital or not. And they'll essentially run the business, so to speak. And that's basically the face of the people that you deal with on a day-to-day basis, the running that syndicate. And sometimes managing agents actually run multiple syndicates because of their expertise. But they're the ones, that's the front house expertise that runs the business. You have cover holders. So Lloyd's themselves, through a term called, whether you've heard of the term underwriting agents or managing general agents, sometimes Lloyd's will actually allow these managing general agents to bind insurance on behalf of the Lloyd's syndicate in London. So, for example, where we work, Willis Towers Watson, we have a managing general agent company that has cover holder status. So if we want to place risks into the Lloyd's of London market, we can do it through that vehicle without going to Lloyd's, because we've got cover holder status and we can bind those risks without having to go there personally. That's a lot of smaller classes. Complex risks, you always want to be there in person. And then there's insurance brokers, which is us. So we're the ones that have actually got to provide the solution. We will look at a full sweep of... We will look at the full sweep of what's happening within an organisation. We will look at available insurance capacity locally and internationally. And sometimes if we feel that Lloyd's of London is the right place to deploy or get access to that capacity, we will head in that direction. So that said, whether it be supporting the establishment of skilled labour in the Middle Ages, whether it be underpinning the commencement of international trade when the new world started to connect to the old, whether it was protecting business and life against catastrophic events such as the Great Fire of London, insurance has actually shaped the modern economy in which we all operate in. So our question or our challenge to people with those original negative comments is it time we respected the role of insurance? A lot of laughter going on. Yeah.
We should have had a voting slide.
We should have. Yeah. What is not included in this slide or in this presentation deck, but I would encourage everyone to catch up with us for a drink afterwards and to give you an idea and insight into the power and strength of insurance, is Daniel's been personally involved in a very, very significant project working alongside the CSIRO. Insurance is the vehicle that is being used to save the Great Barrier Reef. You believe it or not. And Daniel, if you're interested in learning more about what that actually means and how could insurance possibly have a part to play in saving the Great Barrier Reef, go and have a chat to Daniel after and he'll explain how it actually works. It's genuinely fascinating.
Under the guise of an NDA, which we have signed. It's not actually launched yet, but I can give you an insight.
You can share what's been released in the marketing
Absolutely.
materials. Yeah, yes. Now, just a bit of a sobering insight for you and understanding the importance of insurance. Here's some interesting stats for you. So firstly, if we look at the graph on the right, which is insured losses since 1970, that trend, as you can see, is still increasing. A lot of that, there's a lot of things that have been happening worldwide. We've got worldwide catastrophes in 2021 hit US 112 billion, the fourth highest individual year since 1970. And then you move to the next box underneath that, natural disasters exceeded the previous 10-year average, and they're growing and compounding at a rate of 5 to 6% every year. Natural catastrophe losses are likely to continue to grow more than global GDP, given the various increases in wealth, urbanisation and climate change. So the downer message is don't expect your insurance premiums to be going backwards anytime soon. Understand the realities of what's actually happening out there, but also understand there's ways you can manage your way through that. Then we moved on to 2022. And Jeff's already spoken at length before about the Ukrainian war. You might find it fascinating that there's an image behind there with all this aircraft. The main reason for that is, from an insurance industry perspective, the single biggest insurance loss that's going to come out of the Ukrainian war is actually political risk or political violence where the Russian government confiscated all of the aircraft of international airlines that were in Russia at the time. So all of these leasing companies that essentially owned that aircraft thankfully took political risk insurance. So when that asset gets confiscated by a foreign government, that triggers a claim. Now these claims are actually going to end up going through the court system for years on end because it is such a grey area. But at this stage, it's going to be one of the single biggest losses in Lloyd's history. Lloyd's have already said they will not be profitable in 2022. And the number that's currently been bandied around is around 20 billion in aircraft losses alone, before we start talking about some of the other specifics such as credit risk, contract frustration because you can't get things done anymore, agriculture and other commodity losses. So when you think about the war in the Ukraine and insurance, it's not just the loss of life and property, there's actually a lot of other very significant factors happening around it. COVID, another great topic. absolutely fascinating in this country because most businesses have the ability to acquire business interruption insurance. If an event stops your business from running, then you can submit a claim and actually have your revenue protected. Now in the UK, in 2021, their Supreme Court said that they were going to find in favour of the insured. So if an insured submitted a claim as a result of COVID and they could no longer run their business, then the insurance industry was compelled to pay. So what happened as of January 2022, what's that, 967 million pounds of claims settled already, over 42,000 claims at an average of 22,000 or 22,500 per policyholder. Massive impact on the insurance industry and another hit that Lloyd's of London are taking in 2022. However, in Australia, current legal case hasn't gone all the way just yet, is finding in favour of the insurers. It's got to go all the way to the High Court yet, but the current status is it's actually the insurers that are winning, which is contradicting what's happening in the UK market. So if you were impacted by COVID and you weren't able to run your business and you are in the process of trying to lodge a business interruption claim, just be mindful of the current status of it because everything's essentially in a holding pattern until that gets resolved. And then there's the Australian floods. This 2022 flood event, so far, and it's growing every week, if I change this slide next week, it's 3.35 billion in losses so far, not including, as the comment down there, the May 2022 ones which happened just sort of last week or the week before. But to put that into perspective, by comparison, that big Brisbane flood in 2011, that was 2.07 billion, so way, way under where the current one is. Catastrophe losses in Australia in 2021 are 2.28 billion. This one's already 50% higher in isolation. And then for context, we've suffered 28 or say 29 billion in catastrophe losses over the past decade, which compares to essentially half that in the decade prior. So there are many, many impacts happening around us. What I'm going to do now, I've done the easy part. Daniel's going to tell you how you can actually work your way through this and make life easy for yourself. So, cue the comedy show.
And thanks for a journey down your childhood for most of that section. Thank you. So what does it all mean and how does it impact me or my business? I think the easiest way to describe what's happening right now is underpinning it all by a sobering reminder that insurers are in business to make money. Don't ever kid yourself otherwise. Don't worry about what your broker says, messages that come through at time of claims being paid. Insurers owe their shareholders a rate of return. So that's what underpins a lot of their decision making. So as Brent touched on earlier, premiums continue to rise to cover insurer losses. Those losses are not going away. It's easy to, like we think about the people impact and the impact on businesses when we see major losses happen around the country or around the globe. But when in our industry, we always look at those to think, okay, what is going to be the flow-on effect to insured payouts? When we talk about capacity, there's one thing that is on the minds of most brokers. You've got capacity and you've got cost. The first thing is, can we get the cover? You worry about the other bit later. Can you get the cover? Because you'd be surprised how many businesses are out there operating without choice with major risks that they cannot actually access insurance cover for. Risk management becomes mandatory. In a hardened insurance market, the typical go-to point for a broker is our role, remembering that a broker's role, we advocate for our clients. Underwriting agencies, insurers, they're all advocating and they're representing the interests of the insurer. We represent the interests of our clients. So when we talk about risk management becoming mandatory, we know that the insurance industry and the insurers, those that are exposing their capital to these risks, we need to present our clients' risks in a particular way that differentiates you to your competitors. So we have to talk about ways that you're going to mitigate risk, why you're a better risk than others within your industry. Insurers require a deeper understanding of business exposures. You'd be surprised how little information insurers are actually happy to go by and to underwrite a policy in a soft insurance market. They become a bit too transactional. Their main goal is let's get revenue in the door, and their claims performance becomes second. That has absolutely changed. So in a hardened market, they need to underwrite every bit of information to the nth degree.
And just on that, there was a report that came out last week that said post-COVID, of all the small business community or the SME mid-market sector in Australia, 23% of all companies had changed the suite of products and services that they offered to their customers, and 17% said that they embraced e-commerce or digital distribution. So if you are one of those and you have changed your business model and you haven't advised your insurer, your insurance broker, please do so, because of what Daniel just said before around making sure that your genuine risk is being presented to the insurance market.
So I've just been given the very subtle 5-minute warning, so we'll breeze through the next bit quite quickly. We've got another polling question, which will only open up for 30 seconds to a minute sort of thing. What are the most significant risks facing your business? Some good thoughts in there. And what it actually shows you, for those that can read it, because the print's getting a little smaller, we've got political comments in there, we've got financial comments in there, supply chain, people, major perils, clients. So when you ask the question, or when you consider the question, you know, the significant risks that are facing your business, that question will be answered differently by everyone in this room. But they're all very real. They're relevant to you, so that's what matters. I'm an insurance broker, as has been mentioned, so I'll give you a bit of an insight in terms of, with an insurance mindset, because that's the world that I live in, what I think the top views, the top risks facing businesses are. I will sort of draw a line down, you know, sort of 3/5 of the way. I say that the first 3 are insurance related, and I think talent management and continuous disruption, which we'll get to in a second, I'd question whether insurance has a direct role to play in managing that risk. I won't go into a lot of detail on it, but pandemics, you talk about policies being made by government, stepping in and out of support, the availability of staff, customer availability. Doors are being shut because businesses can't access people. Supply chain interruptions, everything that we're all living and breathing to varying degrees. You know, COVID started a lot of it in recent times, and what's happening in Russia and Ukraine is only adding further pressure. Cyber, fair to say it's been done to death. But just a couple of soft reminders is, when you think about cyber and you sort of also consider the impact of COVID, the amount of staff, particularly in CBDs, that are now working from home. When you think about cyber, one of the biggest vulnerabilities of a businesses are throwing a lot of money at cybersecurity, but the biggest weakness is its people and how people manage those ongoing and constant hacks, phishing attempts and the like. I'll give you just this one, you know, a personal thing for myself. My mum, bless her, believes anything that anyone will tell her. Too trusting. So I've actually given Mum the guidance. I was up in Brisbane only a couple of weeks ago, and I said, Mum, whenever someone contacts you by phone or by email, treat them as if they're trying to steal from you. And it's only now that she's actually started to forward me how many instances there are. I don't know if she's on a database for hackers or what, but I was in the lift with you only earlier this week, and I said, here's another one. It was from the ATO. So they're real, and there's a lot of vulnerable people out there that will actually fall victim to it. So that's, and another one is the way that cyber impacts business being done. I'll admit it, I've got an investment property, Jeff, and I refinanced it recently with the CBA. The CBA called me, they sent me a text message to let me know that they were going to call me at this time from this number, because businesses are just used to the fact that people won't pick up their phone calls if they don't recognise a number. Yep, sobering thought. Access to affordable insurance. So this for me is the two-pronged approach. You've got accessing capacity, that's the first priority. We've got a part of our business that's called broking, and their basic role is to go and transact deals with the insurance market for particular size clients that we do have. Their first reminder to us is, we'll access capacity. They don't even want to talk about cost or extent of policy coverage, deductibles, limits. No, let's just get capacity. Let's know that we've got an insurer who's actually willing to put their capital down on the line. Then after that, you go and negotiate cost and the like. All of these reminders, weather perils, you go, look, employment practices law, in terms of claims being made by employees against their employers, class actions, going back to COVID, travel insurance claims. You'd be surprised how the mindset of businesses out there, if they know that they're backed by an insurance policy, they can very easily make a decision to cancel a trip. So if there's a group of people, whether it's a school or business, and there's 30, 40 people travelling together, they're very willing to make a decision to cut that trip if they know that the insurer is going to kick the can. Very different mindset if they know it's backed by an insurance policy. Now, the last two, as I mentioned, I think, look, there's not a direct insurance solution there, but I tried to take my insurance broking hat off. Talent management. We spoke about the shortage of people. That's real. We're seeing it in our industry, and ironically, what we're seeing is, if you think about the hierarchy of people, those with less experience, those with more experience, it's actually here where we've got the gap. We're struggling to find people, new entrants coming into our sector, which that then puts pressure on succession planning and everything else that comes with it. And as far as continuous disruption goes, disruptors and the pace of disruptions coming through disruptors, but equally, I'd almost throw the challenge question out there that are businesses going to face somewhat of fatigue by the constant challenges and headwinds that they're facing just to keep their business going, let alone keep it profitable? So they're my thoughts, and like I said, they're my thoughts and my thoughts alone, and everyone else has got valid thoughts that are relevant for yourselves. How can you manage business? How can you and your business manage and treat risk? You've got three options, so I'll keep it fairly simple. You can transfer it to an insurer. You can mitigate that risk, so whether it's increased fire protection or whatever the case may be, or you can avoid the risk altogether. So avoiding the risk altogether, you might be in an industry where it's difficult to get cover for public liability losses working with children, right? But if your client base goes from, children all the way up to people in their middle age, move the dial up. That's the avoidance piece. I've oversimplified it, I know, but they're the three simple ways that you should consider risk, because insurance policies are going to be harder to access and more costly to access. So really, businesses have to take more ownership over how they treat risk moving forward. Always remember, insurance is designed to facilitate trade, not to prevent it. And in the example that Brent mentioned earlier around the reef, insurance is being used as an enabler. So it's just a different mindset, maybe easier for us to do because we're in the industry, but it's just a different mindset as to how you can become quite innovative as far as insurance goes. So that's enough waffle from us. be kind with your questions, but have we got time for some questions, Rob?
Well, in fact, we don't. Ordinarily,
Well
we'd
timed.
say yes, but we're running short of time. But you two gentlemen are going to be joining us for
We are.
drinks at 5:30. So if there is a question, and I do apologise as well, these things are just compound. Hold that, and we'll talk to the boys this evening over a drink and a canapé. Could you please put your hands together for Daniel?
Thank you, sir.